All right, we're coming to the next speaker slot, which is our discussion panel. So we've heard from Sherman that the ICO wave is over, and let's discuss tokens as a funding instrument and the future for funding decentralized token economies. And with that, I'd like to welcome on stage Jonathan Gabler from Block Science, Jamie Burke from Outlier Ventures, Richard Muirhead from Fabric Ventures, and Erick Zhang from Binance. Welcome.
Thanks, cheers.
All right, good morning. How's everybody doing? So I think the reason why we have this panel at the beginning of the event is because at the beginning of most projects, centralized or decentralized, different types of capital have to come together. Raising financial capital is something that in traditional financial markets is something that's reasonably well understood. So if you're a builder or if you're a project, you know what a sensible deal is, and you have some rough idea what kind of impact it has on the life cycle of your project. In crypto capital markets, it's much less clear. And I think looking at the vast amount of experimentation that we've seen over the last 2 years, it's clear that we're still trying to kind of refine the idea of professional investing or professional fundraising. So what we want to do in this panel is to shed some light on what's happened over the last 2 years, where are we right now, and what are kind of the challenges that projects who want to fundraise or investors who want to invest into these decentralized ecosystems are facing. And I'm very excited to have a super strong panel here. You guys have been at the epicenter of this development. And I would like to start out with basically setting the stage. We've all heard about ICOs, we've heard about IEOs. By the way, I looked at some research this morning from Circle. ICOs still raise more money than IEOs if you take out the outliers. That's actually interesting.
Not outliers companies.
Exactly. But the underlying trends, sort of these mega trends that are going on, they're much less visible to all of us. And this is what I would like to ask you. I don't know, Jamie, maybe you want to start. What are these sort of tectonic plates that have been shifting over the last 2 years? What are these trends that we have been observing?
Well, I think, obviously the market's evolving alongside token design, and things are getting more sophisticated in terms of the technology, the tokens that have been designed and how they function, beyond just as a fundraising mechanism. And then on the other hand, you kind of have these very wild, volatile markets that are typical with any nascent technology. And so I think that creates quite a challenging environment to be issuing tokens, because on the one hand, you have a regulatory environment which is increasingly moving projects towards having full utility at the point of issuing and selling a token. So effectively, they're requiring projects to raise more money privately from professional investors, institutional investors. And so, of course, projects raise money in a given market condition, be that a bull run or a bear market, and they price the project accordingly sometimes. And then 12 months later, they conduct the sale and issue a token, and the market's totally changed. And so that creates 12 months or 18 months in crypto is a long time. And so you've got so many shifting factors. It's not is an unenviable position to be trying to appease early stage investors to make sure that there's going to be the right level of distribution of a token, and then of course to make sure that there's the right level of secondary market and support in that secondary market. So I think it's a natural evolution towards an initial exchange offering, because ultimately that's where the secondary market is.
Richard, does that reflect your experience as well? What are the key trends that you've been observing over the last 2 years?
So first of all, I'd like to basically echo what Jamie said, that people are having to wrestle with this question of which problem they kind of address first and in what sequence when they're trying to build these companies out. But I mean, to summarize our perspective on it, I think a reversion to the kind of fairly well-trodden path of fundraising, going through a very small round at the beginning, pre-seed, pre-product, whether it be in debt or equity, into a company, giving you time to think about the market opportunity and the product, and think about perhaps the way you might design a token to assist your company being successful. Essentially the similar pattern to what we've seen in the past is totally appropriate. I don't want to sound kind of like unadventurous, but I think that structure has been honed, say, for half a century for good reason. But as a counterpoint to that, I do think when the time comes to design your token economics and think about what that part that can play in your venture, there couldn't be something more extraordinary that is happening. I mean, and not wanting to get into kind of let's think back to the time of Mesopotamia and think about organizational structures and so forth. There was a good gag about that, and during Web3. But it's been 500 years now since a guy called Luca Pacioli wrote a book called Summa de Arithmetica, which was basically the first time someone wrote down the principles of double entry bookkeeping and the theory of the firm. And we've essentially had the same model since then. But we've now got an opportunity to turn the concept of debt and equity into some rather trivial type of financial instrument in a much broader universe, where you can involve many different stakeholders, and you can, I think, be even more effective perhaps in building marketplaces addressing very complex problems than Bezos has been in building Amazon, to move to what we think of as a kind of a form of collective capitalism, more effective for the business, and actually ultimately more progressive and more equitable for society as a whole. And that's due to this kind of infinitely programmable nature of the underlying token. So the path may be kind of similar to before, but the tools now at the disposal of the entrepreneur are way more potent than they've ever been, in history. And I think we're entering kind of the next couple of thousand years of using that, putting that to good use, hopefully.
Richard, so Binance, I think, where's Binance headquartered? In Singapore?
In Malta.
In Malta right now, right? But you headquartered in Singapore, I think, right?
Yeah, I'm based in Singapore.
So you've observed the Asian fundraising landscape for a while. I think Binance Launchpad hasn't been around for 2 years now, but you've seen this this development over time, and all of us who've been in this space know that the Asian landscape looks a bit different. There's some nuances that are different. Can you speak to those? And I want to throw in one spicy question there. Last night I had a conversation and I asked people what's the future of fundraising, and when they talk about IEOs, people are not so positive. They're saying, they're way too expensive, and it's not a sustainable model. Maybe you can include that in your answer as well.
For sure. Maybe let me add a little bit onto the trend, the ICO trend in the past 2 years. I think the reason that you just mentioned that ICO still raise more than IEO does is because, for example, Binance Launchpad, we do very rigorous evaluation on those IEO candidates. So only among those, 100 ICOs, only 10% can be selected, get onto a Launchpad, because we need to do full due diligence on across, product, their go-to-market strategy, technology, in order to bring the best to our platform to protect our investors. That's why ICO is still raise more money than IEO. I don't think that person who asked the question really look at the projects we launched, because if you compare the IEO projects that we brought onto our platform, the valuation is lower than their comparables. I think primary reason is Binance Launchpad is not only a platform for projects to raise funds. It's also a good platform for token distribution, right? Also a good marketing tool. And we usually suggest the project teams to use a relatively conservative approach, right? If you compare to the other projects, you can get a reference of their valuation, but position a little lower. That's always the safer and better way. That's why. The other thing is I observed. I mean, you're asking where we're based. So right now, majority of our employees are still in Asia. Part of them are in Malta, across the other countries. The interesting thing we found about the Asian market is people are relatively. I mean, you guys probably talk to a lot of investors, projects in different regions, right? So if you look at the ICO distribution by country, US had the largest number of projects, then Europe, then Asia. If you look at where the money comes from, is Asia, right? And if you look at the secondary market, the percentage of the money from Asia is even higher. But majority of them, I hate to say this, but it's more speculative money. One interesting thing is people in those emerging markets, like to talk about trading, speculation, etc. While in those relatively mature market in the States, Europe, they tend to talk more about the real technology, etc. So, but for us, right, that's also why on our platform we really select those projects that are down to the ground, bring the best technology.
There's two topics that you mentioned that I want to quickly take up and ask Jamie and Richard about, and you as well. And one is token distribution, right? I think a lot of the difficulty in fundraising for these ecosystems stems from the fact that we're using tokens as a vehicle for acquiring financial capital, but we also use these tokens as sort of inherent parts of these, what Trent called the incentive machines, right? And I think that makes it very difficult to define a strategy. So I was, maybe Erick, you could just expand on how do you think about this token distribution at Launchpad, right? So for a given network, there's probably an optimal token distribution across roles in that particular system. Is that something that you look at all?
Yeah, we do. We sometimes work with the projects to design the token distribution to make it fit to the current market condition. For example, this year, since the beginning of this year, the market hasn't been doing great. It was pretty weak. So we usually suggest the project teams issuing for the initial circulating supply is around 10% of the total supply. Because if, on day one, if you release too much, the market is not great, it cannot sustain, right?
How do you guys think about that? Is 10% that's a number, and that may be based on some data that you have, right? That that the markets could support it. Yeah.
Multiple factors, but that's really
How do you think about token distribution? I think we actually have a deep dive talk coming up later on, so we shouldn't go too deep into it. But when you recommend a fundraising strategy, how do you recommend to distribute those tokens across stakeholders?
I mean, it feels a little bit to me like we're collapsing a few questions together. I'd prefer to kind of tease it apart. I think if you just want to go and raise capital, I'm actually bullish about the use of tokens to do that over time, but you just got to wait for the regulatory environment to be right, and that's one thing. If you're going to be using tokens, perhaps to raise some capital, but actually as a fundamental incentive mechanism, then I think the first thing to contemplate is, before you get to kind of what float you have in your ultimate sort of secondary market raise. That's the third step. The first step is think about what are the fundamentals of your token design. Do you want it to be, or do you think it could be a payment token? Do you think it could be a work token? Do you think it could be a token that you're going to have to burn in order to create value in the remaining tokens? There are going to be two tokens. There's a lot of that's what we're going to be talking about here, I'm sure, in great detail, and understand in your model conceivably how value is going to accrue to that token over time, and convince, if you're going to mix that role of fundraising and incentive design, convince everybody involved that it's going to be the case. The second part is going to be, and this is what I think about it in terms of token distribution, is really the expanded version of what any good startup founder has already done. You have to think about rounds of capital raising, but also rounds of option allocation to, and maybe inviting in strategic partners to buy some of the equity in your company. That's the distribution of tokens that you're doing. And any company gives thought to that and perhaps lays out a plan for how much is the executive team going to get. I'm going to partner with Visa. How much am I going to sell them in my business, and so forth. And you lay it out. It's not going to be absolutely right, but if you have got a clear view now of why there is utility and value in this token, and you have a clear budget essentially over time for how to distribute it, then you're set up in a good position to raise your capital at the beginning, and then the question of how big the float is, well, from my view, that's just a question of how bullish the market is at that point in time, and you probably tend to constrain the supply if it's a worse market, and you go bigger if you want to take the capital, and it's a better market.
I'd just build on that and say, when you're designing for a token economy, what is the role of capital providers in that economy at its various stages of evolution? And so that is a design choice. The reality is that in the earlier period of experimentation, there wasn't much design thought put into the impact of the various financing rounds and that stakeholder group. It was assumed that the end user would also be the investor, and so it kind of had a unified concept of what that stakeholder is. But of course, as we know, in many instances, some of the main users are speculators, so not even long-term capital providers. And I think that's okay. We now can design for that, to accommodate it or to restrict it and limit it. But there's just so much variability, and that's still really driven by your geographic presence. If you're in the US, there are so many constraints as to how you can design the role of a capital provider that shift projects much more to a conventional structure. And so, equity is a way to keep the capital providers out of the token economy in a way, and unless it kind of converts at a certain point. So it's really a design choice. I think as the market matures, as we kind of get more data points and more experience as these things evolve, the role of people like us, you could say, well, actually, the role of, let's say, a pure play a venture capitalist who's just deploying capital is fairly limited. It's contained to the early stages of a project. And actually, we want them to exit that token economy at a fixed point. And you could do that in a structured way. So it's a managed sale of assets rather than a kind of a dumping on the market. Or equally, you could say we want to lock people in with more kind of conventional vesting terms, which is very typical in venture if you want to kind of lock people in. But even then, what are you locking them in for? And what value are they going to provide beyond capital?
I want to segue into actually the second topic that I want to take up from your response, Erick, and that's fundamentals for crypto capital markets. So in traditional capital markets, when supply and demand meet, then they can typically look, for example, at balance sheets, and there are some practices that are accepted to determine the valuation and the fundamental health and value of a company in this case. For crypto capital markets, there's really little empirical evidence that any of the metrics that we're currently looking at are sort of correlating with price in secondary markets, for example. What are the trends that you're seeing? Are there some fundamentals emerging that are useful, or are we still kind of winging it at the moment?
I mean, I'm happy to answer, but I don't know if Erick wanted a shot. I mean, I would just say that sadly at the moment there's very little correlation between at least what we understand as fundamental measures of network health. We have an internal measure of network health within a given network. Some of that's universal measure and some of that's specific to a network. However, there is the ability to kind of have a degree of prediction of price. But this is primarily momentum trading. We're still in a period where most price action is just momentum trading because the tokens are very thin liquidity in the market, and so there's a huge opportunity to game that system. And so thinking from a systems design perspective or game theoretics perspective, there is currently a massive incentive to game that system. So again, it's a design question actually. How could you design that out of the system?
So the bottom line is there aren't that many networks out there that have got, true usage, and therefore sort of trying to get some empirical data to inject in a model and work out fundamentally what it should be worth is sort of limited to a few different networks. And if you take, Bitcoin, obviously it's in a sense it's sort of money and meme driven to some degree. I'm a Bitcoin bull in a broader sense. But let's leave that to one side. I think you can look at something like Ethereum and look at fundamentals like gas price and the quantity of Ethereum locked up in decentralized finance, starting to look at how it's securing, applications that are starting to be driven. So, but I think a lot of the value of Ethereum is, in a sense, its financialization now as well. So it's more challenging to look from a kind of fundamental valuation perspective, although people do. I think more interesting is, rather than trying to work out whether publicly listed tokens are valuable or not, is rather to analyze the fundamentals for new projects. And there are sort of two types of project you might want to analyze kind of from the bottom up. One sort of, in a kind of simplistically a kind of burn token type model like Maker, and look at the stability fee, and look at the amount of Ethereum locked up, and there are various fundamental measures that can give you a sign of network health and growth and so forth. And I think now in that DeFi space, we're seeing a diversification going on in the overall ecosystem as well, which will create sort of competition, which I think will be healthy across Compound and other platforms too. So that's great. And then looking at work tokens of the like of Augur or Keep or Orchid or LivePeer, for example, I think looking at the participation in staking, is key, for example, and look at how the inflation rate has been set to incentivize people to do that staking. Look at the split between the rewards for those who are staking, between block rewards and transaction fees, and still in that context, even the ones that are live network-wise, are really immature, and that's fine. But you can see fundamentally how in that work token context, that if there's the price of being able to participate in that network and do profitable work is that you stake some of your tokens, and that ultimately you will be rewarded in transaction fees. That is really just like a deconstructed discounted cash flow that you need to do to value that network. It's not, although like all modeling, you have to be clear what questions you're trying to answer when you try and project it. It's absolutely doable. And so those are the types of analyses that we do from kind of the bottom up.
Eric, is that similar what you do at Launchpad? I think when we chatted yesterday, you said you do evaluation on companies that come through your Launchpad, and a BitTorrent is a different valuation than a more seed stage kind of project.
Right. So previously we tried multiple different sophisticated models, right? We tried, for example, to use the equation of exchange, right? MA equals to PUA, right? So it's a wild estimation. Like what Jimmy said, you guys probably tried many models as well. So I think given the immaturity of the crypto market right now, those complicated models just doesn't work. Simple. So we would rather, but we still have to do valuation for our IO projects. So we usually do comparable valuation to look at the similar projects in that vertical. some people may argue that the price on the crypto market right now is not very good estimator, right? Because it's the deviation from the true value and the price is huge. I mean that also happens in the stock market. To be honest, that always exists. But on the other hand, you have to know that the market is always right. I mean it takes into all those factors that you are aware and you are not aware of. So we think, that simple method is the most suitable way for us to do valuation right now.
Yeah, I mean, I'd add that to that question that the biggest challenge is price discovery, especially when you've had long periods of lockup or liquidity. So there are some really interesting mechanisms. There's a guy called Jason somewhere over there who recently wrote a paper on ICO, which is how do you establish a price at a way where the market can set that price either in advance or during a sale. So I think there's going to be some really interesting mechanisms coming through that will allow that to happen, and that should allow for kind of, aside from the wider macro movements, allow for more stability. But then I think to kind of pick up on the last point, as we, in the first talk, it said these are complex systems. One of the major limiting factors to date has been that people have put they've hard-coded assumptions into the design of a network, which invariably proved to be wrong, and they're too rigid in the way that their governance is structured to be able to adapt to the market. So I think we're going to start to see more adaptive systems. For us, a really important point is, this idea of decentralization in a kind of binary sense. It's centralized or decentralized, and it must be totally decentralized at the beginning. By the way, a pressure that regulators are forcing on without really understanding the consequences of that, is that if it's totally decentralized from day one, what that means is it's then very difficult to make changes to something, which makes it fragile, and fragile economic systems aren't great. So for us, decentralization should be a pathway, but regulatory environments make that quite challenging.
Can I just talk about the infamous equation of exchange, where there's been quite a bit of chatter about it over an extended period of time. So here's my perspective. I'm not an economist, I'm kind of an optimistic engineer, but in understanding the history of the equation of exchange, it's basically a supply-demand equation applied to money. It's a macroeconomic theory that's existed for about 100 years, and if you look back at all of the contending kind of philosophies relating to it, and there probably are almost philosophies, it's almost never had any predictive capability, and quite often, in fact, it's got kind of inverse predictive capability when applied to the kind of real-world economies. So trying to apply it to a new sort of more micro digital economy, which actually isn't even directly applicable, because I would argue that money, as we've traditionally known it, does not have all the programmability, customization, adaptability that you've got in a token. The ability for it to be involved in work and to be burnt, to reward people for devoting computing resource or for providing reputation, for providing liquidity, all of these different things in very intricate ways. And so I just don't think it's usefully applicable. It's like you're trying to, it's overly simplistic.
Well,
I try to maintain that to a friend of mine, John Pfeffer. He told me it was the worst investment thesis he had ever heard, but I stick by it.
Just add on to the end of that, again, it was presented in the keynote that the benefit that we have here is we have a feedback loop compared to traditional economics. So not just within the individual token economy, but the kind of presumably an interplay between token economies. So in theory, if we can create a governance model that can allow for adaptability and response to that feedback loop, then we could have economic systems that are more measurable, quantifiable, adjustable.
Just want to quickly add to
a quick point. Yeah. I just got the signal that we're gonna wrap up soon.
Yeah. So I think in the future, when we have more data points, we know how many users can be converted from non-blockchain space to blockchain. That will give us more data to estimate. Right now, the DAU of all the apps is like 10. Right. I went to Jimmy's party the other day the DAU is 50, right? So, I mean, that is very, very hard to estimate right now. But in the future, I think when we have more users.
As a last question, just to get very practical, and I wanted to quickly ask, how many projects and builders are here today that are potentially fundraising? Okay, so that's a lot. How many investors are here today? Okay, awesome. So that last question is, what is the single biggest piece of advice that you would give to a project that's building a decentralized network that's going to fundraise in the next 6 to 12 months? And we have to be quick because we're going to have to wrap up.
I just say keep it simple and don't forget basic startup, lean startup principles, right? You validate an assumption before you kind of commit it to code.
Yeah, so echo that, build on that. A startup is not a company; it's a kind of a vehicle for experimentation, and decide which experiments you want to, run and investigate and in what order. And remember that Google went from like 98 to 2002 and was still languishing, back in the pack in the peloton somewhere, hadn't broken ahead, and then it kind of combined a few different elements from go to Overture, put it together and suddenly leapt forward and was about to run out of cash effectively, leapt forward and 2 years later was worth 36 billion. It's very hard to see what the business model is going to look like, and we are playing with a lot of business models here, hard to see it in advance. So, run the experiments, keep the faith, and keep being excited.
So our suggestion is just be a little patient. Don't be in a rush to raise a lot of money, right? In the primary market, you can give a portion to those early investors who can bring true value to you guys. Later, if you want to do another round, you can consider doing a public round, where you can make the tokens more widely distributed, right? That's the users, those investors will become more motivated to use your products, so to become your users.
Awesome. Thanks all for listening. That's all we have time for. Please join me in giving the panelists a big round of applause.